this Fund 7 because, like previous investments Jason and I have done, and all of us, we're taking what's typically deemed as high risk investments and de-risking them, doing everything that we can. And Fund 7 is the most de-risked oil drilling program that we've done, and that basically, in my opinion, you can get your hands on.
What we have found to be most lucrative for us as far as investments like this is having the right blend where maybe 3/4 of the revenue is generated by oil and a good fourth or 30% maybe is by gas, because sometimes when we have the oil prices slide back down due to some geopolitical reasons, is that the gas has actually balanced things out and effectively provided a hedge of sorts with it.
If let's say prices go to $30 a barrel, and we know that people are still going to potentially double their investment returns, we're still going to drill, baby, drill, right? We are still going to produce from the wells that we have.
We're trying to maximize the returns on this stuff. Rosedone is not incentivized to just spend. They are in fact incentivized to be lean, as are we. And what we're both aligned for is basically maximizing returns through production.
We're very excited. As Jason mentioned, we've already given Rosedone a significant amount of capital here in the past 60 days to get started. That shows our commitment and excitement, and I really couldn't be more excited about what's coming here in Fund 7.
We are excited for the drilling to start in August, and would love to have you join us in this opportunity.
I like this. We're dealing with the same A-team. We're in the same field. We drilled right next door, so we already have all those logs, all that information. I like taking high returns and reducing the risk, managing that risk any way I can, and that served me well. And I like this fund. That's why I'm kind of digging through the couch cushions, trying to find some more money to dump in this deal.
I'm Kim Kohler, and I will be facilitating our call today, as well as I am your, let's just say, investor concierge. I own a company called Collectively, and we provide white glove services to investors. And I'm so happy to be partnering with CapEx Ventures and A&E Investments. And I'm really happy to be able to help you guys with an amazing investor experience throughout this entire process. Emily, go ahead and take it away. Slide 2, I think it is, or 3, Jason?
Great. Thanks, everyone. My name is Emily Courtright, and I'd love to introduce CapEx Ventures. CapEx is currently in 4 active energy funds, oil and gas. They most recently went full cycle on a deal, exceeding investor expectations in just 2.5 years. And I would say that their experience with oil and gas spans multiple types of funds. So they do new production drilling, they've done value add drilling, and they also incorporate Bitcoin mining, and they've proven the Bitcoin mining out on previous funds. Now, prior to oil and gas, they did do deep value add multifamily syndications. And that's actually how Adam and I originally met them, was through our multifamily syndication experience. Now let's talk about Jason. Jason is an IT professional in his past life, co-founded 3 IT consultant companies. And little known fact, he's fully fluent in French and a very experienced instrument rated pilot. And then Will Crozier is an experienced entrepreneur and investor across multiple industries, including globally. And his expertise is really the Bitcoin mining operations on the team. And one of the coolest parts about Will, if you follow him on social media, and the most rewarding parts, I would say, of his life is his philanthropy efforts in the Philippines, building orphanages and funding vital medical care for children. So his charitable efforts are really an inspiration to all of us on the team. So CapEx Ventures is the lead asset manager, as well as Adam and I. So Adam and I from A&E Investments, Adam and Emily, we are engineers by trade, but we transitioned to real estate investing back in 2013. And we got our start with single family, then we transitioned to multifamily syndications. And now we are diversified across oil and gas, mortgage notes, real estate. And one of our passions is translating what we've learned in the investment space to all of our investors and our database. So both Adam and I have a passion around teaching and coaching. And it's one of the things that just really drives us to continue to learn and continue to share our experiences with everybody that we come across. So we are really excited to be part of this investment and learn from Will and from Jason, the oil and gas industry. So let's talk high level about what we're going to discuss today. The executive summary. Overall, this is a collaboration between CapEx Ventures, A&E Investments, and then we're going to introduce you to Rosestone Operating Company. And Rosestone is the one actually doing the drilling. Jason's going to talk more about them in a minute. We're going to be drilling 6 new oil and gas wells in northwestern Louisiana in a very specific field. They're all going to be in the same field. And Rosestone has over 20 years of experience. So Jason's going to talk about his experience with them as well as some of their track record over the years. Then Adam is going to talk to you about the returns that we project for this deal, which is at 3x over 5 years. And those are based on conservative estimates and the comparable wells that we've already drilled as part of our last fund. So we're going to go into all of those details. Will is going to talk to us about the Bitcoin mining component. And then I'm going to wrap it up talking about some of the deal specifics, including the fact that all accredited investors are invited to invest, and talk about some of the deductions, the tax advantages that we get for this type of deal. So let's kick it off. I'm going to pass it over to my partner, Jason Sharp, to talk more about Rosestone.
Thank you. All right, Emily. Thanks everyone for joining. This is quite exciting. It's always humbling to have such an audience. But I'll dive into it here and give you a little bit of background. I know we've got several of our existing investors in here, including those who have been in the full cycle deal with Rosestone, which was CapEx Fund 2, and then also might be in Fund 6. But Rosestone, as Emily mentioned, has been effectively drilling, has been operating, has been I want to use the word financing, but I guess I'll say accounting, financial controlling, oil and gas operations for several decades, even longer than 20, closer to 37 years if the date is right. Yep. And the interesting thing about them in the area in which we're playing, which is Claiborne Parish, that's parish is a county in Louisiana, part of the old history there, is that they've drilled over 50 wells in that area since 2007. And then they were fairly quiet the past several years. They worked with us on production plays, meaning taking over wells that already were established, but somewhat on the longer tail of the depletion curve. And then we dove into the drilling. So it's actually been a pleasure working with them since 2021, late 2021. But the main thing is very competent, very established. The phrasing, the expectations, timing, financial reports, all those types of things. We were able to have very useful conversations together, which is critical when you're an asset manager and you've got an operator. Otherwise, we've had experience with those that are a lot more challenging, and that gets in the way of successful conclusions. So with Rosestone, things have actually been very positive. And on top of that, since they only work in this particular backyard, we've been able to benefit from their deep, deep knowledge. So what we're doing in this particular field is that it's called the Lisbon Field within the Claiborne Parish. We're going to be drilling 6 wells. The drilling is going to begin in early August. We're learning a lot from our experience drilling in Fund 6 as far as timing, getting basically, as Adam and I would say in aviation, to stay ahead of the airplane instead of getting behind it and then playing catch up. So there's a lot of things that needs to happen in these unimproved areas. So we're way ahead of the game as far as planning. And what we're ultimately going to be drilling are vertical wells, which tend to be less complicated, but they are deep. They're going to be in the 10,005 to 11,000 foot depth if the first 2 are any indication. And why we do that is that, as we see on this graph here with deep vertical wells, is that generally you have enough room to go through different pay zones, basically different formations that each can provide valuable oil and or gas to some ratio, depending on what that formation is based off of. So that's exactly what we're able to do in Lisbon. That's exactly why this particular area is basically ripe with multiple zones. In fact, we basically punched through 3 of them, the 3 we were expecting with our Fund 6 wells. And in this graph, or on this picture, we're able to see that our Fund 6 wells in Lisbon Field are the blue hexagons. And so we've infilled in these areas versus what's called offset wells. Offsets are like comps in real estate, and it's where historically you may have some information to learn from, compare, and then fill your educated guesses or refine them before doing the actual heavy work of drilling and expensive work. Where we're intending to put our Fund 7 wells are where these stars are to easily delineate. And what we're doing is infilling in the best locations these 160-acre units, which is ample large, because if you roll back to the 1940s, 50s, 60s, when this field was initially drilled, is that they were 320-acre units, 640-acre unit spaces, and you're able to downsize those areas now because thanks to technology, thanks to better information, and also thanks to historical performance, we're able to see that depletion doesn't really affect anything that close. So in other words, where a well was drilled before and did great results, it doesn't necessarily mean that it's going to suck dry the rest of the area. So that's where the experts come into play with seismics, with well logs, etc. And then that is how we have an idea of what's there. So we're playing in that same exact area to leverage the results that we have already seen in Fund 6 and then be as conservative as we can with it. So speaking of being conservative, what we're able to see is those comparables or offset wells. That's what those bars are historically. In their first, second, third year, going on into, we only bothered mentioning 15. And in oil and gas, because everything is under pressure, and the lower in the ground, the higher the pressure, is that it will go through a depletion early on to where it starts very high and then starts going down and then turns into a more flat tail. So a couple things I'll mention here about our plan. First of all, to compare everything is that you're able to see a trend, which is this gray line that goes across, of a per well average of how that field has performed with those offset wells. And then what we did with Fund 6 is that we projected something along the same line as what we're doing for Fund 7, which is this green set. And then what ended up coming through was actually very strong results compared to our projections. Early Fund 6 projections for the 2 wells we've drilled in Lisbon, this field, is 2.4 times what we expected from our projections. And then the second well is closer to 1.4. So we did our job right as far as conservatively planning, and that's exactly what we're trying to do with Fund 7. So this is with the oil results, and then with the gas results, is that you're seeing something similar. Now, interestingly here, you see a rise with gas before it drops off. And I've told you just in the prior slide that things begin with a higher pressure. So they start higher and then deplete. So why in the world do we start lower? That's because historically speaking, when these first wells were brought online, there was no infrastructure, there was no sales pipeline, there was no ability to take that gas and sell it. So it was extremely limited, and that was why it took several years for that field to develop and to get the purchasers set up to consume it. So we're basically measuring things now that we have that level of infrastructure existing in the field. We're beginning our comparison against the peak. And especially in gas, our first wells have been tremendously performant. Although I don't have the numbers on here, I'll give you the examples, is that what we're trying to look at from a scale, and I'm going to read from my numbers here, a scale of our ultimate production of a well out there, is that we're guesstimating, we're projecting a 375,000 barrel cumulative, basically over the lifespan of the well. So a 375,000 barrel well. And along with that, a 3.7 billion cubic feet of gas. Well, if we compare that 375 and 3.7 to our first well that we drilled is basically coming in at a projection now, a real projection based on what's coming out of the ground, of 900,000 barrels with 9 billion cubic feet, so significantly higher. And then the second one is at 500,000 barrels with 5 billion cubic feet. And once again, that's compared to 375,000 and 3.7. So if you're wondering why our purple line is only this high, and same with the prior slide, it's because we did the average between the two. Oops, sorry about that. We did the average between those two. So we're not expecting that type of phenomenal return and production, but that's our job. Our job is to make it conservative and then over deliver and do everything we can to increase our odds of financial return, odds of production. So we're very excited to take this on and to have the information and knowledge, experience from Rosestone, as well as all the processes we've got in place to work with them to basically join in this deal and bring the band back together again, if you will. And you guys get to join along. At least we certainly look forward to that. So at this point, I'm going to hand things over to Adam, Emily's husband. He is cut from the same cloth. I love this guy, both as a pilot, as a fellow asset manager, and I'm going to let him take away these fantastic projections and modeling that we've all put our eyes and brains onto.
All right. Thank you, Jason. Excellent job, team. I'd like to also echo Emily's earlier comments of just how excited we are to be involved with this investment. I think it's going to be a really good one, and we are beyond excited to be helping lead the efforts. There's really two things I'd like to impress upon everybody as we take a look at the projections year over year and discuss the underwriting. And really, those two things, as an investor myself, what I'm curious about is, how are the projections constructed? What's involved, right? What numbers make up, and how are they delivered to our team and then ultimately delivered to this screen? And then second, really is how conservative are they? What are the parameters that we can play around with and stress test to just understand what the puts and takes are of the model? And so I'd really, my goal over the next two slides is to really hammer that home. But as you can see on the screen, we've got a year-over-year returns projection, and this is a passive investor return on investment. Basically, it's including your principal payback. We are expecting those figures on the screen, and it's about a 3x. It's a 301% total return, including your principal, for an eye-popping 61% IRR. Okay, and so right away we see the level of excitement on the returns. But what I'd also love to point out is the velocity of the returns is extremely high early on. And we don't always think about this until we're actually in the investment making the money. But just think about what you'll be able to do from a reinvestment strategy, knowing that your returns are front loaded. That's one of the things I'm extremely excited about. The underwriting, what we're using in the underwriting, because this is a very common question we get, is the New York Mercantile Exchange, the NYMEX 5-year future pricing on oil and gas. And when we look at a barrel of oil and the underwriting through the 5 years, we're averaging right around $61 to $63 a barrel. So if you compare that to today's pricing, you can see the futures are right in line. And again, we don't make those up, right? We go straight to a good source to make sure that that's a safe for our underwriting. Another very important thing about this investment, which is really driving a lot of excitement early on, it's one of the reasons we've already been successful raising a few $1 million here at the get-go, is the preferred return structure. So let me discuss this and describe how it works just a bit. As in most other investment vehicles you may have been a part of, the preferred return is meant to incentivize the limited partner so that they can get paid prior to the general partner. And that's exactly what this is. So For those investors that join us by wiring funds prior to June 15th for this project, you'll enjoy a 16% preferred return, meaning when we kick off distributions, you will make a preferred return of 16% where you get paid all of the distributions and the GPs get paid zero on their on their split. So the 70-30 split that you see on the screen, 100% of it goes to you, the limited partner, up to the 16% annualized figure. And that truly is an annualized figure, up to the point you receive 100% of your invested capital back. And so to just use a simple example, if you invest 100,000 and let's say in the first year we are able to return 100% of your capital, you'll receive the first 16,000 that's unburdened by the GP split. So that's how that's going to work. I think that's all I have on this slide. Jason, if you want to.
I have one comment.
Yep.
So the 5-year future pricing for both the oil and gas is published in 2 places. It's in the FAQ document and it's in the appendix slides. So if you look at the webinar slides that are loaded on the investor portal, you'll be able to see the pricing that we're using for all 5 years. Also, in terms of the preferred return, there's an example in the PPM that spells out year by year if you want to see that breakdown of how that preferred return works. So I encourage you to look at the PPM for that information.
There you go. All right. Thanks, Emily. To kind of touch on the second item that myself as an investor is very interested in is just how much can we stress the model, right? Where do the returns go when we really push the limits of the parameters and see where, maybe in, certain circumstances, although they may be very rare, what happens to our returns? And so I've really outlined 3 stress tests here against the baseline model, and you can see them there on the screen. We've got oil price at roughly 50% of what our underwriting model states, so in the $32 a barrel range. And we've got gas price also 50% at what our underwriting model shows. And then I've also got a production stress test where we assume that, hey, what if we only get 50% of the oil and gas production that this model is projecting? What does that do to our returns? Again, this would be a very significantly, I would call it a very rare circumstance, especially given the data that Jason just showed you, the offset well data going back decades, as well as our own CF6 data, which is which we have a successful project going on now. Again, to me, when I look at the stress test here, very acceptable returns, still doubling investors' money, even with potential catastrophic pricing slides on the energy resource pricing there of oil and gas. Also the dry wells, right? If we have just so happen 3 of the wells are completely dry, that means absolutely zero production. That's still a healthy return in this market. And then I also show a, hey, what if scenario. Just again, this gives us an understanding of the breadth of the model, what happens when we look at different scenarios. But if we happen to do as well as the offset wells, again, those were those bar charts that Jason showed you, the potential for returns here. So using the comparable wells, our neighbors, so to speak. And I didn't even bother putting the CF6 data up here. What would happen if CF7 was just as successful as CF6? The numbers would have been too high, right? And again, that's not what we're here to do. We're here to project conservative figures and make sure that we can actually achieve those numbers. Just to wrap up real quick, I think the 3 key takeaways on the model itself that are very important as us as investors to know. The same research, the same seismic data, the same geologic data and projections were constructed for CF7 that we used in CF6. The methods are similar. They're exactly coming from the same team, right? So extremely little variation there. Second, we've got a lot of return on investment to share, right? And so on the prior screen, I talked a little bit about the preferred return. The reason our preferred return is so high, we've got a lot of returns to share with everybody. And 3, again, I'll just restate the velocity of your return. I know for myself, when I get 100% of my capital back, I'll be able to use that in other investment vehicles, whether it be maybe another A&E CapEx investment down the road or something else. But it's extremely critical that we study how fast the velocity of that investment comes back to you. So with that, I'd like to send it over to my buddy Will and business partner, and he's going to talk a little bit about Bitcoin.
Hey guys, Will Crozier, partners with all these fine people. I've been in the Bitcoin and crypto space for about 5 years, including crypto mining for that same time frame. It seems like sort of a strange pairing. Some people don't quite understand, like, why on earth is Bitcoin mining a part of an oil and gas venture? And it's quite a unique take that we put on this. The people that win and make the most money at Bitcoin mining are the people that can source very, very cheap energy. Bitcoin mining is extremely energy intensive. And interestingly enough, in the oil and gas industry, we have one of those sources of extremely cheap energy. And that's because a lot of oil and gas operators or fields produce stranded or waste gas. It's gas that is vented or set on fire, and you've probably seen these driving down the highway at night, even in West Fort Worth or North Fort Worth, where they're just flaring or venting these stacks of gas, and it's wasted and it's a polluting element. And it's interesting that if you can harness this flared wasted gas into large generators, you can power Bitcoin mining equipment, and you can do it extremely cheaply because the energy is otherwise wasted. One example in a recent month in CapEx Ventures Fund 6, we saw our energy bill, and it for the gas that we had purchased, it was $2,000. And if we had run our Bitcoin mine off of electricity instead, it would have been around $40,000 instead. So that's quite the savings in being able to harness this flared and wasted gas, and also, of course, the green component of that, of not directly dumping that into the atmosphere. We have flexibility with this Bitcoin. Once we've mined it, we have the ability to sell it immediately for US dollars, or we can potentially hold that Bitcoin for a little bit longer, waiting to time the market the best that we can to further maximize our returns and results. We've done a proof of concept up in the Panhandle in Texas, which produced 40 to 50% annualized ROI. And Fund 6, we have a much larger Bitcoin mine currently operating, and that's tracking about the same kind of returns. If we proceed in Fund 7 with Bitcoin mining, this component of the investment, we'll likely be purchasing 1 to 3 very large Bitcoin mines. And they'll very likely be located with one of our strategic partners in Galveston, Texas, because they do not have pipelines down there nearby to sell the gas, so they flare it or vent it. Whereas up in Louisiana, we're very close and are already attached to a pipeline. So we're working with partners to utilize their flared and wasted gas for our Bitcoin mining. And as a side note, the returns and the projections that you've seen previously by Jason and Adam, the Bitcoin revenues are not included in those. So this would be kind of the cherry on top of all of that. And as you can see, they can be pretty darn lucrative. So I think that that's it for this. We can pass that over. I think it's Emily.
Great. Thanks, Will. Okay, so let's talk about some of the minimums and the tax considerations. So the managers are contributing $500,000 to this deal. The minimum investment is $100,000, and it is open to all accredited investors. This is an SEC a Reg D 506C raise, so all accredited investors are invited. Now, if you did join us just less than 6 months ago for CapEx Ventures Fund 6, you will have to get another accredited letter. So Kim will talk a little bit more about that. And we do accept investments from either from cash entities or self-directed retirement accounts. Based on the conservative projections, we expect monthly distributions to start in the first quarter of 2026. So again, it may be sooner, but realistically plan on first quarter of 2026. And then let's talk about some of the tax advantages for this opportunity. There will be bonus drilling deductions. So it's called intangible drilling costs. And that's basically all the costs that we incur in 2025 to drill the wells can be deducted in 2025 by the fund. And so that those deductions are shared with all the passive investors. And then ongoing, once there's production, oil and gas production, there are still depletion benefits. And so we continue to get tax advantages throughout the life of the project with the depletion benefits that are unique to oil and gas investing. Now, one of the questions that we've had come in is about how oil and gas relates or differs from multifamily investments in terms of the deductions and depreciation. And with multifamily, it's more so about a bonus depreciation, but that has been tiered down. And currently in 2025, you're only able to take 40% of the eligible bonus depreciation. And so in terms of the same amount of money put into a multifamily investment versus an oil and gas investment, because of the tiering down of the bonus depreciation, you will likely get more depreciation by doing the oil and gas investment because we do get to write off all of our intangible drilling costs. Now, our tax professional will take care of all of that. You don't have to worry about it. And you will get K-1s. That is the tax form you would get for your taxes that would come out in March of 2026. So I'm going to pass it over to Kim to talk about next steps and show you how to get into our investor portal.
Thank you, Emily. All right, so next steps. I'm going to take over the screen sharing for just a moment to show you the portal. When you go to the investor portal, if you are already an investor within either A&E Investments or with one of the with CapEx Ventures, so one of the sponsors, when you go to the investor portal, you'll click the link that you see and it should take you into the portal. It will ask you to log in. If you do not have an account already, it's going to actually ask you to create an account. But this is what actually the portal looks like. And here you will find additional details and information. You'll see the video that you would have seen in a lot of the emails that we sent out already. In addition to that, you'll be able to access the slides that you saw today, as well as the subscription docs, the FAQ that Emily had referred to earlier. And also click here and you can start your investment. One of the things that Emily did bring up was investing in this. It is available to accredited investors because it's a 506c investment. Your accreditation letter needs to be issued within the last 90 days. If it is not issued within the last 90 days, you will have to upload a new letter. You can get that from your CPA. You can get that from an attorney. I have a template. You can email me and ask me for that template. Or we have easily put it in the process when you start your investment. At the very end, after you sign your subscription docs, there is a button that will ask you or let you submit to Parallel Markets. So that is a third-party company that will take and verify for you. It's at no cost. We cover the cost for you, so it's free of charge to you. If you need any additional support, you can go ahead and reach out to me. I will walk you through the investment process and I can answer any of your general questions. And then additionally, if you have any questions that I can't answer, I will make sure that it gets forwarded on to Jason, Will, Adam, or Emily, and we are happy to support you.